Good morning, guys. It is Monday, October 7th. I'm giving you a quick market update for last week. We had a lot going on. Long story short, interest rates ticked up on us for a number of reasons we'll get into in a little bit. For the week, started out on conventional loans, about 6.082 for the national average, and 6.275 is where we kind of ended. So, of course, it doesn't exactly translate to those exact numbers, but basically from 6 to 6.25, and FHA kind of same thing, 5.842 to 6.052. So across the board, interest rates went up. Number of different factors that caused that is going to be essentially market's not entirely sure yet on if inflation is under control, so they're a little skeptical. So anytime any kind of reports come out that are showing maybe a stronger economy or inflation isn't quite under control, or there's any kind of concerns, then we're going to have kind of a big impact on mortgage rates right now. It's going to be a little volatile. We had, of course, the jobs numbers that came out last week that showed higher. There was some Fed talk that was a little bit more hawkish, meaning they're looking to control inflation a little bit more. And, of course, the port strikes and some concerns there for supply disruption and causes to inflation. So we'll get into that here in a minute and go into some detail. With the BLS Jobs report, so that multiple different job reports come out during the month, and they're going to tell us if there's wages are increasing, jobs are increasing. This one was a little tricky. The last couple of jobs reports have come out saying that the economy is a little bit weaker, that the jobs are coming down, that there's more layoffs, there's people aren't making, they're not increasing their wages. This one was a complete opposite of everything that has been happening for the last couple of months, and basically where the BLS, which is Bureau of Labor and Statistics, comes out and says this many jobs were created, then they would revise the previous months once they review everything, and they would revise them down. On this one, there was a big jump of 154,000, I believe, on the expected number. And then they also revised the previous reports that they had revised down. They revised them back up. And so it made all of those numbers jump significantly and look like, there was some big jobs numbers. And that's not good, of course, for what the Fed's trying to do when they control inflation, because that's too fast, right? There's a lot of different things that go into it. This is very basic explanation of kind of what's going down. But that's what happened this week, and that's what caused mortgage bonds to sell off, and of course interest rates go up. Now, part of the other thing to look into this report is everything kind of increased, but also weekly hours decreased. And the jobs, 55% of the jobs that were created were in the age range of 16 to 19 years old. So it's kind of the numbers were good, but also kind of a tricky situation where, are they really that good? Because, 55% of the jobs in the country are created between 16 and 19 years old. Those aren't, high-end paying jobs. Those aren't homeowners that, so it's a little bit of a mixed bag. Doesn't make a whole lot of sense to be that strong, but it was, and that's how market reacts basically to headline numbers. The other factor that we had for the week was, of course, the port strikes. So if you watched any of the news, the largest labor union or port workers union in the country went on strike. And so that is also a concern, or was a concern, because it's over now. Thank goodness it only lasted a week. There was a lot of talk and strong feelings, of course, where there was some expected consequences to the economy, to jobs, to a lot of different, situations where if this strike lasted longer than a week, we could be in some real trouble. So luckily it didn't last that long. It was just the week. But there is some concern, of course, because when the ports shut down, then we can't get the imports and the supplies that we're needing, the things that we're trying to use every single day. Of course, everybody knows and freaked out, went, oh, we got to go buy all the toilet paper. Whatever it was that, people thought, hey, I need to go do this and get themselves squared away for this situation. Causes supply and demand issues. And whenever you have a supply chain disruption and issue, then prices go up, and that's bad for inflation. Of course, inflation, as we know, bad for bonds, which is bad for mortgage rates. So that's part of the other thing that on top of the economy and the jobs numbers, then you had this going on, and how's that going to affect us? There was some big concerns about inflation over the week, and so here we are, higher mortgage rates. And luckily, again, that's over now, so we can kind of go on about our lives, but we will see those numbers show up next month and also next October when we start seeing some of the inflation numbers next year as inflation is coming down. How does that 1 week really affect the inflation numbers? I don't know that it's going to be a big number or a big effect on there, but it'll have some effect on some of those numbers because, we all know, like, all of a sudden gas jumped up a little bit. So we'll have to see how that really affects us in the long term. The last piece of what we're looking at this week going forward is, of course, the economic calendar, news reports, and Fed comments, and all of those things are front and center as always, but technical signals. So, there's some ways of simplifying how this works, but essentially there's trading signals of price that a trader or an algorithm is going to buy or sell a mortgage-backed security. And when we look at these, it creates patterns. Well, right now, what's happened with last week is we have broken through a couple of layers of support, which is significant for where we're at. Now, we were getting kind of pinched a little bit on things were either going to get better, and that would mean rates would continue to get better, or we were going to see them kind of stall where we were at. And we kind of warned about this a couple of weeks ago that we'd have to see where we were, but it looks like we kind of priced all of the interest rates, and we've priced all of that stuff in already, and then we kind of stalled out waiting for the Fed cut. There was no surprises there, and so interest rates kind of stayed flat. They did tick up just a little bit when that happened, but the overall was really a muted reaction. Well, now we're seeing that sell-off, taking profits, concerns of inflation and jobs, and so on, and we've broken through those technical signals. So what ends up happening is if you take a tennis ball and you bounce it, it's going to hit a floor, and then it'll come up and it'll hit a ceiling. It hits a ceiling and comes back down. Kind of similar to that, where we've come through, and now instead of being on the 5th floor, let's say we're down now on the 3rd floor. We've cleared a couple of them. Now we're going to bounce around in that range, so interest rates will kind of flatten out a little bit from where we're at. It's a very big range, so we can see interest rates swing, 0.25% or so here or there in any given day. So there's going to be some big movements. You can see maybe a quarter depending on characteristics of the loan, but we will see some big swings until market kind of settles, and then some of those things shrink down a little bit as far as the ranges go, and then we're going to break above or below that again, ideally. And what the expectation is that we'll go above that, which will cause interest rates to continue to get better. So we mentioned this before, nothing moves in a straight line, and if they did, then that'd be nice and easy. But there's got to be some profit taking and giving here and there, and that's kind of where we're at right now. So we had a nice point. Hopefully, people took advantage of it. You got some refinances people took advantage of, and that's the time to do it. Now we're kind of out of that time. Still lower than where we were, but we missed a little bit of a window there. It'll take a little while for that to come back, maybe a week or two, maybe a month. It'll start to come back, and then interest rates will be right back to where we were, and then continue to get a little bit better. So think of it like a staircase, up or down, either way, and that's kind of what we're going to see. And right now we're just on the upside of interest rates for this particular cycle. So I hope that helps you and your clients. If you guys have any questions or need anything, feel free to reach out to us. We're happy to help.